When people hear the phrase financial celebrities, they often think of success stories, bold predictions, and effortless wealth. But what they rarely see is the invisible architecture supporting those fortunes. The deeply intentional way these individuals diversify their portfolios to protect themselves from the silent forces that have destroyed countless fortunes throughout history. Diversification is not a modern invention. It is an ancient survival instinct embedded in every empire that ever endured more than a generation. And the most respected financial celebrities, people like Warren Buffett, Ray Dalio, Cathie Wood, Kevin O'Leary, and even non-traditional voices like Dave Ramsey or Suze Orman, did not build wealth by scattering money randomly across assets, but by balancing exposure to risk in a way that aligns with their worldview, temperament, and long-term philosophy. What the public sees is results. What the seasoned investor sees is structure. Because in finance, structure is destiny. Warren Buffett is often misunderstood as someone who doesn't diversify because of his concentrated bets, yet Berkshire Hathaway is one of the most diversified conglomerates in the world, spreading risk across insurance, energy, railroads, consumer goods, financial services, and sprawling equity holdings. Buffett himself once said, "Diversification is protection against ignorance." But the deeper truth behind his philosophy is that concentration is only safe when it is built on a foundation of extreme diversification at the enterprise level. His personal approach is not a rejection of diversification, but a sophisticated layering of it, where the core is stable, cash-generating businesses that act as ballast, while select high-conviction positions create asymmetric upside. This is not diversification in appearance. It is diversification by purpose. Ray Dalio, on the other hand, sees diversification not as a defensive maneuver, but as a mathematical necessity. His all-weather portfolio is designed to survive inflation, deflation, growth, and recession, 4 economic seasons that have cycled for centuries. Dalio's approach is rooted in the belief that no one can predict the future, so the portfolio must be engineered to perform well in every scenario. While others diversify by industry or geography, Dalio diversifies by economic outcome, a far deeper form of risk balancing that reveals why Bridgewater remained resilient across crises that shattered lesser funds. His philosophy reflects a principle older than Wall Street. Do not bet on the world behaving the way you hope. Bet on your ability to endure the way it will. Cathie Wood presents a stark contrast. Her approach to diversification is thematic, not defensive. She aggregates high-risk, high-growth innovation, plays in genomics, robotics, AI, energy storage, and blockchain, not to spread risk, but to amplify a long-term thesis. To outsiders, this looks like a lack of diversification. But in reality, she diversifies across technologies, timelines, and disruptive trajectories that rarely correlate with traditional markets. Her conviction-based diversification is a reminder that different investors diversify not based on fear, but based on their vision of where the world is going. And for some, the future is not a place to protect against. It is a place to capture. Then there is Kevin O'Leary, whose diversification strategy is shaped by ruthless pragmatism. He spreads capital across dozens of businesses, not because he fears loss, but because he understands that most ventures fail and the survivors must compensate for the failures. His philosophy mirrors the logic of venture capital. Diversify, not to feel safe, but to ensure that the few winners have the room to grow into empires. O'Leary's diversification is less about safety and more about statistical inevitability. He knows the rules of the entrepreneurial battlefield. Diversify your bets, but do not diversify your standards. Even personal finance celebrities who focus on the everyday individual, like Dave Ramsey or Suze Orman, embrace diversification at a more foundational level, using mutual funds, index funds, or simple allocation frameworks that shield ordinary investors from the volatility that destroys undisciplined portfolios. Their philosophy is built on behavioral diversification, reducing the chance that emotions will trigger catastrophic mistakes. This may appear simplistic, but in truth, behavioral risk is the greatest threat to financial independence for most people, and diversification is the emotional shock absorber that keeps them from self-sabotage. What ties all these philosophies together is not the assets they choose, but the underlying principle guiding their decisions. Every financial celebrity understands that wealth destructs faster than it compounds if left exposed to concentrated risk at the wrong point in time. Diversification, therefore, is less about spreading money and more about managing psychological, economic, and structural vulnerabilities. Buffett diversifies to amplify stability. Dalio diversifies to engineer resilience. Wood diversifies to express conviction. O'Leary diversifies to increase statistical certainty. Ramsey and Orman diversified to protect the everyday investor from themselves. These approaches appear different, but they are merely different expressions of the same law. Concentration builds wealth, but diversification preserves it. Yet the public often misinterprets diversification as an act of fear. In truth, it is an act of respect. Respect for uncertainty, for volatility, for the limits of human prediction. Financial celebrities diversify because they have been humbled by markets that punished arrogance, rewarded discipline, and taught them the cost of ignoring risk. Those who survive long enough to become financial celebrities are not the ones who avoided mistakes. They are the ones who insulated themselves against fatal ones. And here is the paradox the inexperienced investor rarely understands. True diversification is invisible. It is felt more than seen. It appears in cash reserves that provide optionality during downturns. It appears in assets that move according to different economic drivers. It appears in liquidity strategies, tax planning, and position sizing long before it appears in a list of holdings. It is not the number of eggs in the basket, but the independence of the baskets themselves. And the financial elite understand that diversification is not about maximizing return, it is about maximizing survival, because only survivors get the chance to compound. Look closer, and you will see another truth. Diversification is not static. It evolves as wealth grows. The beginner diversifies to avoid ruin. The wealthy diversify to avoid regression. The ultra-wealthy diversify to avoid concentration in any single world order, currency regime, or political system. This is why many financial celebrities allocate across real estate, equities, private businesses, intangible assets, intellectual property, and increasingly, alternative markets like private credit, venture capital, or digital assets. Their diversification reflects an understanding that the world is not stable. It shifts, sometimes violently, and the portfolio must shift with it. Yet the most important insight is this. Diversification is not only about protecting money, it is about protecting the identity of the investor. A person concentrated in one asset becomes psychologically enslaved to that asset. A person diversified becomes free to think clearly, free to make long-term decisions, free from emotional turbulence. The greatest financial celebrities diversify not because they fear losing wealth, but because they value the psychological independence that diversified wealth grants them. That independence is the real luxury. And so, when people ask how financial celebrities diversify their portfolios, the question they should be asking is why they diversify, because behind the why lies the wisdom that turns strategies into principles and principles into enduring wealth. And it is only by understanding these deeper motivations that the everyday investor can learn to apply the same timeless laws to their own financial life laws that have protected kings, merchants, magnates, and modern billionaires for centuries. Laws that reveal diversification not as a tactic, but as a philosophy, guiding every investor who understands that longevity matters more than excitement, survival matters more than spectacle, and the future belongs not to those who predict correctly, but to those who prepare correctly, especially in a world where the winds of money shift faster than ever, and only the well-diversified stand a chance to endure the storms that inevitably sweep through every economic cycle. Because the true test of a portfolio is never how it performs during calm markets, but how gracefully it survives the turbulence that exposes the fragility of undiversified wealth. And in those moments, when the world trembles under the weight of uncertainty, financial celebrities reveal the quiet genius behind their strategies. They do not react emotionally because their portfolios were built to anticipate chaos, not to fear it. This is the difference between the amateur and the master. The amateur diversifies to feel safe. The master diversifies to stay powerful. One seeks comfort, the other seeks longevity. And longevity, in the world of money, is the closest thing to invincibility a person can ever achieve. But there is another dimension the public often overlooks. Diversification is not just about assets. It is about time. The wealthiest individuals diversify across timelines, short-term liquidity, mid-term growth, long-term legacy. They structure their decisions so that no single moment can destroy them. Short-term cash protects against emergencies, mid-term investments, fuel expansion, and long-term holdings, often in private companies, real estate, or intellectual property, anchor the future. This temporal diversification is rarely discussed. Yet it is the true backbone of sustainable wealth. It prevents panic. It ensures flexibility. It empowers patience. And patience, as every investor eventually learns, is capital in its purest form. Financial celebrities also diversify across purpose. Some assets are held for cash flow, others for appreciation, others for strategic influence, and still others for protection against the unknown. A rental property pays for stability. A basket of equities offers growth. A stake in a private venture provides upside asymmetry. A reserve of cash creates optionality, the ability to act when others freeze. And increasingly, alternative investments like art, music royalties, private credit, commodities, or digital assets stand as hedges against the fragility of traditional systems. This is diversification not by category, but by intention, a subtlety the inexperienced investor rarely grasps. Yet the greatest insight comes from understanding that diversification is not merely a technical act, but a psychological one. The portfolio is a mirror of the investor. A fearful investor diversifies chaotically. A greedy investor diversifies too little, but the wise investor diversifies with clarity, aligning structure with temperament, so the portfolio becomes an extension of emotional discipline. This is why financial celebrities appear calm in crises. Their portfolios are built to protect their minds as much as their money. When your money is stable, your mind is stable. When your mind is stable, your decisions become powerful. And powerful decisions, not luck, are what compound wealth across decades. Consider how these celebrities navigate cycles of euphoria and despair. During market booms, diversification prevents them from overexposure to bubbles that eventually burst. During downturns, diversification gives them the liquidity and courage to buy assets the fearful masses are dumping. They do not fight the cycles. They position themselves to harvest from them. This is the true purpose of diversification: to win not just in good times, but through all times. And it is this consistency, this refusal to let a single wave determine the fate of the entire ship that separates legacy wealth from temporary fortune. And then there is the dimension of identity diversification, perhaps the most underrated of all. Financial celebrities diversify not only their portfolios but their identities so they are not psychologically tied to any single source of income. A single income identity is fragile. When the income dies, the identity dies with it. But when a person sees themselves as a builder, an investor, a creator, a strategist, multiple identities, their financial engine becomes infinitely more resilient. This protects them from the emotional devastation that accompanies financial setbacks and empowers them to reinvent themselves when required. In a world changing as rapidly as ours, identity diversification may be the most critical skill of all. Look far enough into the history of wealth, and you will find that every dynasty that survived mastered diversification not as a tactic but as culture. They diversified across geography to escape political risk. They diversified across currencies to hedge against regime collapse. They diversified across sectors to adapt to changing technologies. They diversified across generations by teaching principles rather than handing out riches. Financial celebrities who endure follow the same pattern, whether consciously or subconsciously. They build systems, not just portfolios. And systems outlive circumstances. So when examining how financial celebrities diversify their portfolios, we must go beyond the superficial and recognize the deeper laws silently operating beneath their decisions. Diversification is not scattering. It is engineering. It is not fear. It is foresight. It is not complexity. It is coherence. And the investor who understands these layers begins to see diversification not as something you do at the end of a financial plan, but as the foundation upon which every intelligent financial decision rests. Because the truth is simple. No one can predict the future, but everyone can prepare for it. And those who prepare across assets, markets, time horizons, identities, and economic regimes are the ones who stand tall while others fall. They are the ones who turn volatility into opportunity. They are the ones who do not merely survive crises, but transform crises into catalysts. That is the power of diversification, when practiced with intention rather than imitation. And it is why financial celebrities, despite having wealth large enough to gamble recklessly, rarely gamble at all. They understand that wealth is not maintained through daring, but through design, through discipline, and through a profound respect for the forces that have humbled every arrogant investor since the dawn of commerce, reminding us that diversification, at its core, is not an investment strategy, but a philosophy of survival, strength, and sovereignty over one's financial destiny. In a world where the only constant is that everything eventually changes, and only the well-diversified have the resilience to